Hey guys, John Paulamy here, Actionable Intelligence. Today is Saturday, July 13th, 2019, and this is the weekly market update. So, in this week's reality check, I kind of want to go over what I'm seeing out there as far as the world economy. I'm not a big prognosticator on economies and trying to use that as a way or a tool to do my investing and speculating. I like to look at individual sectors and individual companies or countries. Like I said before, people know me. I like to look for bombed out places that have a potential to turn around, or industries or companies. So, predicting economies, predicting unemployment, looking at all this stuff, there's a lot of noise out there. But it is becoming obvious that the world economy is beginning to slow down. This is the longest expansion in U.S. history, I believe. And typically, recession or economic expansions don't just stop on their own. They're usually killed, as I heard one commentator say. I really liked how he said it. Something comes along, whether it's interest rate increases by the Fed, cutting off the money supply spigot like we are by doing quantitative tightening. You're basically strangling the economy. Otherwise, it will continue to expand. It eventually will run into constraints around labor and materials, which is what we're starting to see. But that's late cycle type situations. So I'm not going to get into a lot of economic theory. What I wanted to point out was that it's slowing. And what's interesting is people are talking about interest rate cuts in the U.S., but if you go to the website of the Council for Foreign Relations, they have a page where they track for the majority of the larger countries in the world where they are in the interest rate cycle in that particular country. And what it shows is that if you look at the majority of the world, or the countries that matter, I'm not talking about some rinky-dink country like Haiti or Guatemala. I'm talking like major economies in Europe and Asia and around the world. They have a continuum, and I will put this link in the show notes. They have a continuum. I think it goes to -10 to +10, and 0 being like neutral. And right now, the world in total, if you total everything up, is at -7. So it's extremely loose monetary policy around the world, and it's going to get looser in my view. That's what central banks do. They create inflation. Inflation is not an increase in prices. It's an increase in credit and currency units. It manifests itself in rising prices eventually, but that's a whole nother video. What I wanted to talk about was, the United States is slowing down. It's becoming apparent to me. We have an election cycle coming up. I've never seen a more aggressive presidential administration, as far as commenting on monetary policy and criticizing the Fed. And President Trump, he runs this thing in about 15-minute increments. I mean, let's just be honest. He wants to get reelected. It's not going to look good if we have a big recession right before the election. So he's jawboning the Fed. There's a lot of market anticipation. That's why the stock market's making new highs. Even though the economy may be at the end of its expansion, because people are anticipating that the Fed is going to, go through this rate cutting cycle, and we're going to have more monetary shenanigans. I really don't know what's going to happen. I think that if they don't cut rates in July after all the buildup, you will have a big pullback in the stock market, and the clothes will be ripped off the emperor. But that's that's a mug's game trying to predict this. What I am saying though is around the world, monetary policy is loose and going to get more loose. And I think this bodes well for precious metals and commodities in general. And I've pointed this out ad nauseum. As you create more currency units, you cannot increase the supply of commodities or more labor, whatever. Prices have a tendency to increase. I think this will manifest itself in higher commodity prices. One of the things I've shown is I've juxtaposed the highs in the U.S. stock market in the S&P and the Dow against the prices of commodities, and they are at extremes. I mean, commodities are at like 30 or 40, 50-year lows in relation to the stock market being at highs. So, I'm a big advocate and fan of reversion to the mean, and I would suggest that there's quite a bit of potential for resources and commodities to rally as the stock market comes down. Now, they could both go down, they could both go up, who knows? What I'm saying is that the setup looks pretty good, and this is a longer term call. This isn't going to happen in the next week or two, but I think that, I'm becoming increasingly bullish on gold. I think that the uncertainty in the world and the economic situation and the currency units that are going to be printed are going to blow people's minds away. Now, having said that, I took the advice of one of the watchers of the videos. I can't remember who you are out there, or I'd give you a shout out. We kind of got into a little bit of a back and forth about modern monetary theory on a couple of videos ago. And the guy, this person, I don't know if it was a guy, probably, suggested that he had, recently read Ray Dalio's book, Big Debt Crises. And I picked it up. I said, I'm going to read the book. I do know a lot about monetary policy and monetary cycles, but I was really surprised about how in-depth the book is. I haven't finished it, but I'm about halfway through. And Dalio really does a good job of explaining the monetary policy cycle, the effects that it has on the economy and on asset prices, and how these things are very cyclical and mechanical. I mean, he talks about how during a deflationary contraction of credit, how the Federal Reserve or any central bank can use various tools to counteract that, and how they have to, how that's done. I think it's very good. It's very easy to read. It's not wonky, and I suggest that you buy the book and read it, because this is going to be your future. Extreme monetary policy combined with physical policy is going to come to the head as we go through the next recession and the next financial crisis. And, the next crisis, I think, one of the things I'm monitoring to give me a view of when the next crisis is going to start is the corporate bond market. The corporate bond market is completely infested with low-quality bonds, quite a few zombie companies, a lot of debt, trillions of dollars of debt of, companies, bonds who are trading at what they call triple B, which is one step above junk. So it's not going to take much if the economy turns down for cash flows to be constricted at companies and for them to run into trouble making their debt payments. So why I think this is a big deal is going to be a tremendous opportunity to make a tremendous amount of money. It may be a once-in-a-lifetime opportunity on the downside and upside. Let me explain. Trading bonds is not the same as trading stocks. Everybody that's listening to this knows they probably have their brokerage account on their phone. If you want to buy 100 shares of, Exxon, you just go on there, put 100 shares, put in XOM, boom, it's in your account, it's done. You can do a limit order, market order. You can do the thing in seconds. That's not how bonds are traded. They're not that liquid. And the problem is that a lot of people and a lot of institutions have been chasing yield into these higher yielding, lower quality bonds. So you have billions and billions of dollars that have been stashed in these bonds chasing yield, because you have insurance companies, you have pension funds, you have retirees, and if you can't, you used to be able to get 5% in a passbook savings account. You used to be able to buy CDs for 6 or 7%, and that's what people would do. They'd retire with a couple $100,000. They'd get their Social Security for like $18,000 a year, and then they'd be getting $12,000 or $13,000, $15,000 a year in interest off their, $200,000 or $300,000 in savings. Well, that doesn't exist anymore. And the same thing with pension funds. They need a certain amount of return, 7 or 8% a year, to meet the obligations for the pensioners that they support. And they haven't been able to get that because of this zero interest rate policy we've had for the last 10 years. And there's no yield out there. So people are having to go further and further out on the risk curve into crappier and crappier bonds and debt instruments. I mean, that's how the whole shale thing got financed. I mean, high debt or higher risk, lower quality, higher interest rate debt, $350 billion. That's what financed the whole shale revolution. There's no revolution. It's debt financed malinvestment. So The problem is that when the economy eventually turns down, which it will, I'm not making a prediction it's going to happen now or who knows when, but you have to look at certain things and watch it. The companies that are zombie companies that are living on just barely making their interest payments, these things are going to come to the head. And what's going to happen is there's a lot of ETFs out there. There's a lot of people holding these things in large quantities. And when they all go to the market to sell, it's not like just going to your phone or going to the computer and hitting sell and it's a liquid market. I've traded bonds. I've owned bonds. Bonds are good investments on some companies, shorter term or companies that are coming out of bad situations. I look at these things. You can get decent yields. But it's kind of a pain in the butt to trade these things. You got to go out and go to sometimes you're going to make several calls to several different brokers and actually talk to somebody. They have to go out and look for a buyer, look for a seller. It's very opaque. It's very illiquid. So what happens when billions and billions of dollars in bonds want to get traded right now, or somebody goes to their ETF, because you can buy an ETF that owns these crappy bonds on the stock exchange and starts hitting the sell button on their phone, which you could do, and now all of these mismatches in redemptions for this ETF come in, they got to dump these bonds, and there's not going to be buyers from them. So there's going to be big gaps down. This happened during the last recession, 2008, the GFC, and the credit quality has gotten worse since then. So what's going to happen with a lot of these companies? Everybody's going to the baby's going to get thrown out with the bathwater and the baby's sister, because there's just not going to be any liquidity. Everything's just going to get pummeled. And you're going to even have good companies or companies that can make their bond payments that are going to get thrown out too. And, during the last GFC, I missed this, but I did the research on it after the fact. There were good quality companies, bonds, selling at the bottom in 2008, at 25 to 30% yields to maturity. And they were making their payments. And they subsequently recovered. So you're buying this bond that's severely discounted. It's giving you basically a yield because it's discounted, because it's been, you have the capital to step in and buy this thing. You're getting a 30%, yield. That can create a lot of wealth real quick. So I think on the way down, when this thing gets going, there's some short funds out there I've talked about before for bonds. I'm going to intend on writing that down. We're not seeing that yet, though. We're not seeing that credit quality. I'm thinking that things are slowing down, but it hasn't manifested itself yet in any type of panic or sell-off in these bonds yet. But it's coming, in my view. So that's what I'm watching. That corporate bond market, when it cracks, I think that's going to be a tremendous opportunity on the way down. And then when it bottoms, I think, eventually the Federal Reserve will come in with all who knows what, how much QE or programs or I don't know what. But, we've seen this in other countries that have had these debt crises, and these central banks will do whatever they need to do to keep people from rioting in the streets. They'll print as much money as they have to, and then if they have to go in and buy the entire corporate bond market, they will. Look at Japan. The Japanese central bank basically owns the entire Japanese government bond market. They've also owned quite a bit of common stocks and, bonds of corporate entities. So, these central banks will do whatever they have to do. Whatever constraints they supposedly have on them will be jettisoned. And I think that looks good for gold. I don't see any reason why gold doesn't look good long term. Now, when I say long term, I'm talking 3 to 5, 10 years. I think you need to own it as insurance. I've showed that Ray Dalio video as a insurance against central bank and government, malfeasance, if you will. But I also think there's opportunity in gold equities, and I'm going to be talking about that more in the newsletter. I really like the royalty companies just because it's really difficult to find, mining really sucks as a business. I'll make a video about it. But I think there's going to be some opportunity to do something there. So we'll be talking about that more. Now, I know everybody wants to hear about Section 232. You probably already know if you are engaged at all. Everybody was all worried about this, wondering what was going to happen. So finally, the Trump administration issued a memo yesterday. And I'm just got the highlights here. I'll put a link to the memo. You can read it yourself. I will say, to preface this discussion, that the Trump administration is very pro-nuclear. They want a revival of nuclear power. They even say that in the memo. They've been saying that. Secretary Perry's been out there. So they are behind the nuclear power industry. I just don't. I'm not sure that they were ready to go where some people thought they needed to go or were going to go. That doesn't necessarily mean they won't eventually, because I think they leave it open if you read the memo. But basically, here's a couple snippets. The Secretary found and advised me of his opinion that uranium is being imported into the United States in such quantities and under such circumstances as to threaten to impair the national security of the United States as defined under Section 232 of the Act. Well, that's readily apparent. We've talked about that before. You basically have 20%, 19 to 20% of the U.S. electricity being nuclear-based, and we're importing like 95% of our nuclear fuel from places that probably don't have our best interests intact. We also have a very large nuclear navy. All of the carriers, I believe, at this point now are nuclear. I think all the conventional fuel carriers have been retired. We have, nuclear submarines. They require, this is a national security situation. Not only that, if you just cut the nuclear fuel off to just say you could snap your fingers and 20% of your power plants went away, it would be, you'd be in a depression tomorrow and people would be dying in the streets. It would not be good. So they do recognize that's an issue. But this is what I found interesting. It says that at this time, this is the president now, I do not concur with the Secretary's finding that uranium imports threaten to impair the national security of the United States as defined under Section 232 of the Act. So basically, they say the Secretary has the opinion that, Secretary of Commerce has this opinion, Secretary of Energy has this opinion, but the president doesn't agree. So, but he did say in here that they're going to establish a United States Nuclear Fuel Working Group to develop recommendations for reviving and expanding domestic nuclear fuel production. So what that means is there's basically more news to come. So this working group is probably going to put together some recommendations. I don't know what they're going to be. I don't even want to speculate on it. I really don't care at this point. We just have to see what happens. I don't think this is really a big deal. I've said this in the past. A lot of people have made this into some end-all, be-all, this Section 232. To my mind, and I've stated this on several occasions in the past, this is not the major issue. This is what Section 232 in the uranium deal was a wet blanket on the market. It was creating a lot of uncertainty with the electric utilities, with the market, with investors, with everybody. And markets don't like uncertainty. I think the most positive thing that could happen, it didn't really matter if it was a positive or negative outcome, however you view it, there is an outcome now. We know that this, we have got a ruling, if you will. So the uncertainty is now gone, and now that that's removed from the market, markets, like I said, they hate uncertainty, and now will we see real price discovery begin to take place? Will U.S. utilities that now know that they can buy their uranium from whoever that were waiting, you didn't want to go out and commit, millions of dollars to buying uranium fuel from Rosatom or Kazatomprom or somebody like that, and then be told that you got to buy a certain amount from, U.S. domestic sources or Canadian sources or whatever that people were speculating on. So the fuel cycle now doesn't stop. The amount of uranium being burned as this video is being made doesn't stop. So they have to enter their contracting cycle. So this takes the uncertainty away from the market. And like I said before, that's the biggest takeaway from this whole thing. I would kind of recommend people. I really like. I've been following this guy on Twitter. I'll put a link to him, Marcelo Lopez or Marcelo. I don't know how he pronounces it. I think he's from Brazil. He runs a hedge fund down there. I think it's called L3 Investments or L2 Investments. They put their he tweets a lot. He's in the uranium Twittersphere, if you will. And I really liked. He put out they put out their investor report or whatever to their investors, and I really like what he said in the last letter. But just keep it simple. This is not a hard thesis. Four points. Very simple. Keep it simple, stupid. Point number 1. Is demand increasing? Yes. Is supply contracting? Yes. Is the price of uranium at an incentive price that will allow for the creation of more uranium mines, more uranium supply? No. Is the price of uranium detrimental to fuel buyers? No, because they have huge sunk costs, and even if the price is $25 a pound or $125 a pound, they're still going to buy the same amount. It's immaterial what the price is, basically. So that's really what you need to focus on. Until any of those four change, you don't have to worry about anything. You should be stacking. You should be buying quality uranium companies. That's what you should be doing. If you're not where you need to be position size or where you think you need to be, I mean, I continue to buy. I keep buying. I have my names. I keep buying these things because nothing's changed except for the uncertainty's now been lifted from the market. So I'll put a link to his Twitter. I mean, you should be following him already. I mean, most of you guys are following all these people. You should know this already. But I just wanted to put these charts up. The petitioners were UR Energy and Energy Fuels, and you just see how they got slammed. I mean, this is, people have, tweeted at me or emailed me, well, what should I do? I mean, what should you do? I mean, is the company still meeting the thesis that you bought it for? If you just bought this because you thought you were going to get a positive 232 outcome, well, I mean, you put your money on red or black. I mean, that was a gamble. If you still think this is a quality company, I don't have an issue with either one of these companies long term. I meat this looks like a buying opportunity for me. I'm not personally buying these, but I think there's better companies. But I do own a little bit of Energy Fuels. But it would be a buying opportunity if you were so inclined. I mean, here's Energy Fuels. I mean, they got body slammed also, and we'll just have to see what happens over the next couple of weeks. They'll probably recover. But now we already saw, the uranium spot price was moving up already yesterday. So I think, through the end of the year, I think we'll see a strengthening in the uranium price now. I'm waiting for those first few contracts to leak out of what people are signing contracts as the contracting cycle starts and whether we see, see improvement in those pricing. I mean, every day that goes by, this is what people forget. This is an extractive industry. Every day that you're not replacing what you're taking out of the ground, okay, you're slowly liquidating your business. And if you want to stay in business, you have to invest in new resource. The resources are out there. There's plenty of uranium out there, but it takes, it's going to take hundreds of millions and billions of dollars to get to this stuff. And it's not like, right now, I mean, a lot of the young people, I think, don't understand this. You can't just sit up all night and drink 4 Monster drinks and write an app to create more uranium fuel. It's just not how it's done. I mean, there's a contract, there's a permitting cycle. You have to get financing. These places, mining's not that popular anyways, and uranium mining is especially not that popular. There's not a lot of huge jurisdictions that are really jazzed up about uranium mining, and that takes time. That takes, 10 years. And then you have to actually get into the business of mining. And that's not easy either. Building the mine, you get cost overruns, commissioning screw-ups. We didn't build this correctly. We didn't anticipate that. And then running the damn thing, you run into, you thought, you had certain drill holes, you had a resource calculated, and then you get into a spot where, the resource doesn't match what you thought. I mean, it's not the best business to be in anyway. So what I'm trying to tell you is that every day we're getting more and more demand. We're getting more and more use of this fuel, and we're not getting any replacement. So the industry is liquidating. So that's not going to stay that way. Let's put it that way. So that's my view on 232. It was a fart in the wind, basically. The wet blanket's off the market now. The uncertainty has gone away. And I think that we'll just have to see if this was really holding things back over the next weeks and months and see if the fuel buyers come back into the market. So that's it for this week, guys. Thanks for listening, and we'll talk to you next week.